And I think they even mentioned on Twitter that they, brought it up to PumpFun, and PumpFun didn't really want to even use that pool. They'd rather build their own. So I think in the future, like the success is really going to be on how they can actually defend their dominant position in terms of meme coin trading.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey guys, welcome back to another episode of 0x Research. Today I'm joined by Jacob Sharples, otherwise known as 0x Sharples, Mark Arjun, and Carlos from the research team. Happy to have Jacob on. He's been making the rounds on the timeline lately with a bunch of great data, and we definitely want to talk about some PumpFun related data and a big dashboard that he helped put together. But before we get into any topics today, I do want to do a quick shout out for Permissionless 4. Coming to New York this summer, late June. We've already been rolling out the shills for the next event, but I want to make sure that we let the listeners know to get your tickets to Permissionless. Check the link in the description. As always, the code is 0x10. Get 10% off tickets. We hope to see you there. A bunch of guys from research will be there. It'll be a great chance to meet and mingle with people from Blockworks and around the industry, as always. So hope to see you there, and let's dive into it. So before we get into maybe the crypto specific stuff, I think the general market is maybe a big question mark, and how that relates to the sector and risk on more broadly. Tariffs are the talk of the town, the talk of the world, actually, not just the town. And this last week and then today, markets have been doing crazy things. We've got global markets around the world going limit down, hitting all the circuit breakers, tons of crazy things happening. Some like coin telegraph intern-esque news sending markets into a bit of a whirlwind here this morning. I'm curious your guys' thoughts, just general takeaways from like the last week, last few days. How are we thinking? How are we feeling?
I guess I can start just from a price perspective. I think I've been surprised by Bitcoin's relative strength, uh, both in regards to the SPY and QQQ, but also in regards to other crypto assets. Like if you put it in context, um, BTC is still above pre-election levels, whereas like Solana and ETH are both seeing lows like you hadn't seen since the beginning of 2024 or late 2023. Um, and like if you look at, for instance, at the Sol BTC ratio is down like 30% year to date, and it just speaks, in my opinion, to uh, Bitcoin following a cycle of its own, which is something that we repeated like in past episodes, and like positioning itself as a non-sovereign form of money. And whereas Solana and Ethereum are just competing in a completely different category. And I think like Bitcoin, and I think this is something Mark can speak to a lot better, just has like a whole different market structure, like with the ETF flows that has allowed it to remain a lot more resilient.
I want to prompt you there a little further there, Mark. We saw, I think everyone got out their narratives this weekend around, Bitcoin is decoupling from risk markets. That was the whole narrative and thought. And then Sunday and then into today, it kind of ticked down, maybe sort of lagging the indices that have been down over the past week. I guess like more broadly on Carlos's point, like what are your thoughts there? Is it actually decoupling? Is it actually in its own sort of like special market regime, or are we just deluding ourselves right now?
I think maybe it's a bit of both. It is like what Carlos mentioned. It is in its own class relative to, Ethereum and Solana. And I'm also surprised it held up so well, especially with 5 weeks of billions of dollars of outflows from the ETFs. The vehicle that's supposed to be a tailwind for it was actually, for a period of time, going against it, but it still remained pretty solid. Um, the decoupling narrative is not really something I believed in. I track Bitcoin's correlation to SPY and Nasdaq, and it like my last report I put out earlier this month, maybe last week. It was pretty high, the highest it's been for some time, and I think it really depends on the data you're looking at. Like how are you measuring it? Are you looking at weekends as part of it? Because unless you're doing with SPY futures, and are you doing it a 7-day rolling average, a 30-day rolling average, right? And I think for something like Bitcoin, maybe a shorter time frame might be a little better, like a week, 10 days. And you see here that it's becoming more correlated. And and there was a spike again for the first time. Trump mentioned the tariffs in late February. And so anytime we see any geopolitical events, the correlation with Bitcoin and equities is increased, even though it might not see that on paper because it tends to be weekend announcements. So Bitcoin will trade, and then on the Monday markets open, and Bitcoin's already made most of its moves, whereas equities are catching up. So I think that's a little bit of the difference there. But overall, I mean, we're at 79K at the time of recording. I mean, it's held up pretty well. I mean, even gold has pulled back today, and on Friday. So even that's considered a safe haven asset. It's still pulled back. So I don't think the pullback removes Bitcoin from being in that category. It's a time when everybody's reconsidering the allocations in their portfolio, and Bitcoin's no different.
Yeah, it's a great point. I think the comparison that a lot of people are looking at now is going back to pre-election to now numbers for a lot of, if it's indices, if it's other crypto, and just seeing that like Bitcoin is still hanging out way above the levels that it was at pre-election, and lots of other things are trading well below where they were at that same time, which kind of speaks to that maybe outperformance that we're still seeing here. I guess if we go further, like speaking more generally now that markets are kind of like all over the place, getting shaken up, what are our outlook like generally? And I think we've talked about Bitcoin a little bit. If you have more to expand there, Mark, that'd be great. But like there's sort of the big three majors here, like Bitcoin, ETH, and Sol. Um, like you just mentioned, Bitcoin, it's still sitting above pre-election levels. ETH has become sort of like this, I don't know, all of the people who used to be hopefuls, it seems like more and more at least the CT timeline consensus is like, oh, maybe it actually is dead for real now. And I still see optimism around Sol, but yet, both ETH and Sol are trading, well below where they have been over the past few months. And, we're looking at like 2023 type of price levels.
I'll just give my quick take on ETH. I kind of see it now as like the Intel to the Nvidia, right? Once the market leader of the world, now losing out to the new sexy play, which might be Sol in that case, or it could be Bitcoin's the TSMC with the hardware, and the the analogy between the two is both, the foundation as well as the board and CEO of Intel know that there's issues and they're turning things around. There's restructuring both in EF and in Intel, and they're they're doing things to, they're now hearing the problems a bit late. Probably a lot of the market was telling them these issues years in advance, maybe 6 months ago, and they're now doing things to kind of turn it around. But they're still large companies, and they were the leaders, and it was almost like they were mature. Intel had a dividend. Ethereum was, burning more fees than it was emitting. And that was a very huge selling point for it. But now, I think Ethereum is, it's second in terms of DA. It's second in terms of fees, REV. It's, people talk about it as still the leader for tokenization, where institutions are tokenizing their assets, but it's still second in that to provenance, and many people don't know that. So, but being second is not a horrible place to be, right? It still has a lot of mind share. A lot of the L2s use EVMs. A lot of the tokenization pilots use EVM or Ethereum. Like it's still I don't know what it is now, a $200 billion asset, roughly, whatever the price is. So it's a large asset and it's a startup still. I still think it's in a startup phase and it's pivoting its roadmap, so to speak. I don't think it's dead, but I think there's a lot of work and a lot of years to turn this ship around.
I think I would agree with that. I mean, there's this saying like, he who chases two rabbits catches none, right? And I think that reflects on Ethereum's kind of strategy over the past few years, where they've tried to win as the best money, as the best like smart contract platform, as the best like DA solution, but like you cannot be the best at everything. And I think like that's a great point Mark is raising. Like they need to like I don't know, pivot their strategy to something and then be laser focused on winning that market. One of the things that I was discussing previous to this call, like, is just like I think, like in retrospect, like the moment Ethereum chose to not scale the L1 was the moment like it was kind of like doomed, if you will. Like I think when it happened, like at that time, many people, like including me, like were bullish on the modular like scaling roadmap with rollups. But I think like by now it's pretty evident that it's not beneficial for Ethereum DL1 or ETH the asset. And I think people don't want to see it now. Like they will never see it, basically.
I'm curious your guys' thoughts here. It seems like now the plans and the ideas now have shifted to trying to cover all of these bases now. It seems I know Mark, you included this as well in your recent report on increasing the gas limit as well. And it seems like generally the conversation has shifted from like all in L2 scaling to okay, we need to scale the L1, we need to scale the L2. Like we actually need to scale all of the stuff at the same time, and we need to do a lot more of it than we've been doing. I don't know. General thoughts there. It seems like you guys have mentioned, it's a very very tough spot. And going back to the previous charts shared, like losing in DA to Celestia, albeit only from really like Eclipse, a few like chains or apps on those chains pumping a ton of that DA. And then losing in sort of the execution legs as well. Um, it feels like they have now a ton of priorities and they need to scale all of them. And I don't know how realistic that's going to be. And it seems like that'll be even more difficult just given like their ability to ship upgrades on time in over the past few years.
I think, yeah, you're definitely right. They're being stretched thin, as you and Carlos have mentioned. I think what's good about the EF being as big as it is that it has multiple teams that can work on different aspects at once. Um, there's teams working on scaling each of those layers that we said, except the L1. There's teams because I mean that's just pumping the gas limit. But there's teams working on PADAS, on Fusaka, things like scale data availability. There's teams working on consensus, trying to do either single self finality or bringing that down. But I think one of the issues are I can't, as somebody who follows Ethereum, it's hard for even me to get a guise on what the actual path is or how many people want a certain path moving forward, because I see on the timeline from some head figures in the Ethereum Foundation. And like I just said, the Ethereum Foundation is big and there's no one consensus view within it. There's individual members who have their own beliefs, and some of them want to increase the gas limit on the L1 to maybe 100 million within the next 12 months, which I'm a fan of. And there's some who are who hold these strong beliefs that we should do that solo stakers or home stakers need the highest prioritization. And I'm not necessarily a fan of that. I don't think that the network should be held back by the slowest participants. But then we see something like Solana with the SIMD 228 vote, and we got like, I think it was, Carlos, you can correct me, low 60 something percent people were in favor of it. Is that right? Or
So for Cindy 228, you mean?
yeah, what percentage of people were in favor? What was the yes votes?
Okay, so you had like a 74 participation rate, and then how you count the votes is you just count the non-abstaining votes. So among non-abstaining votes, you had a 61% uh, in favor of the proposal. And how Solana governance works is that it requires first a threshold of 33% participation rate that was easily surpassed, but then it requires a super majority of yes for the proposal to pass, and that's like 2/3 of votes, of non-abstaining votes. And in this case, like the 61% fell short of the like 67% that's required for the vote to pass.
Yeah, and so this is kind of my point. Like this level of clarity that we got into what path Solana wants to move forward, and it didn't pass. But we saw that there was a majority of people like the idea of it. Maybe it has to be tweaked, reintroduced again in a few months. But with Ethereum, it's hard to gauge. What percentage of the community wants what, wants more DAO scaling, wants more L1 scaling, and my gauge for that is Twitter timeline, and that's not ideal, right? I'm not saying there's an easy fix for this, but this is another issue that Ethereum's facing as well.
This episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your crypto and logins, trusted by 7 million users and securing 20% of the world's digital assets. Follow the link in today's show notes to grab your Ledger now. I think that covers it fairly well. I think if we jump to like looking at the broader picture and maybe talking about Solana a little bit here in this diagram, in terms of looking at overall like network REV share, it's interesting to note that Solana got as high as 80% of at least the chains that we're tracking here, which should by and large cover the majority of activity that's happening. I did want to mention that both BNB and Tron have increased significantly as a percentage of like the overall REV share of chains. But when we look in nominal terms, I think the story is really more that Solana grew so significantly and then gave so much of it back that it looks like those chains have increased, when in reality, Tron has basically just been clipping along at essentially the same sort of nominal terms of REV over the past several months. And BNB has had some upticks. They've had some meme coin craze activity going on their chain lately. But by and large, it seems their activity level has been relatively consistent, whereas Sol had this big spike and then decline. But I think digging into what you wrote recently, Carlos, in your Solana update note, I mean, a lot of the positives for Sol still look relatively the same in that, highly revenue generating applications are increasingly, dominant on Solana. And I think, when you just think about what those might be, I mean, it's still largely trading related. So like PumpFun is there, a lot of trading applications and dexes surrounding that activity are there. And they're incredibly highly revenue generating and profitable. So it's not surprising to see that. And we've seen Hyperliquid tick up as well. It's been another big winner. Are there other big takeaways? Like what's our outlook and view and thoughts on Solana here and going forward?
One of the big highlights just for me, and we can discuss about how to interpret this, but app revenue has been more resilient than network rev. If you look at network like rev in March, it was like $71 million. That's down like 87% from January's figure. And most of Solana's network rev comes from trading applications, and because you benefit a lot like from contentious transactions and users trying to get the best execution price, and like events like the network like the Trump meme coin like definitely favor MEV and network rev in this regard. But then I've been pleasantly surprised by application revenue has definitely declined, but it has not declined at the same rate as network rev. And if you look at the ratio of application revenue divided by network rev, what you will find is that March was an all-time high for Solana. It was around 1.84. And what that means is that on average, Solana applications are earning like $1.84 per every $1 of network rev today, which like at the end of the day, when you look at like what is the success of a network, you're not just looking at what the stakeholders of the network earn, meaning token holders and validators, but you also want to look at crucially what businesses within the ecosystem or applications are earning. And to me, this speaks to Solana applications achieving product market fit. And even if in declining market conditions, I think we have seen like a pretty good level of like a good floor of activity. What I will say and what I don't like is that March was the first month probably since September of last year, where year-over-year growth is looking very bad. Like if you look at February, like year-over-year growth was still pretty high in this chart. But like if you look at March, year-over-year growth isn't looking as great, and then maybe some of those growth prospects are getting priced in.
I think that up revenue to network REV figure, that's kind of falls into the fat protocol thesis. And then it's probably not just for Solana, but for the other major smart contract ones as well, Bartron. Like it shows that probably still a lot if that trend continues, which I think it will. It shows there's probably a lot of money to be made in the applications, more so like maybe higher beta plays, both fundamentally and just price wise. I mean, I tweeted out today something Jupiter, the PerpsX, I mean it has other platforms as well, but Jupiter in the last 24 hours made more fees, so not revenues, but made more fees than Solana, Ethereum, Tron, and Pump.Fun combined. Right. So this is kind of like showing you how, despite like falling REV, despite these stuff, like some applications can still like gain market share and be seen as more like defensive.
I think that's interesting. Maybe hinging off of that, like I want to dive deeper here, and we've got Jacob on to talk more specifically about a bunch of PumpFun data. Speaking of highly revenue generating apps, PumpFun has been one of the killers there. The downside for, I think, people interested in the liquid token space is that there's no token for PumpFun. So the associated upside, you might have had to find that in other places. But, you know, as you mentioned, Mark, there's other venues where that has been possible. You know, there's Jupyter's tokens, there's Dex tokens, there's other things out there. But when we think about PumpFun, I guess I will jump to real quick. They recently brought back, or working on bringing back live streaming. They dropped an update that the live stream component of the platform is coming back alongside a moderation policy, which supposedly they had the first time around, but maybe was not clear. And they just didn't have the resources to properly sort of watchdog the activity and handle the influx of craziness that was going on in the initial concept. But it is interesting to see them bring this back. I know in a recent interview, Elon mentioned that the team has grown to something like 50 or 60 employees now. I'm sure they've also maybe beefed up some other backend systems to maybe do automated detecting of certain types of things that go against the rules outlined here. But basically, it prohibits all of the content that people were outraged about on Twitter back when live streaming blew up on Pump. So violence, harassment, sexual content, etc. This isn't surprising. When we talked about it back then, I think we kind of saw this as an inevitability. If their desire was to eventually like have this be a core part of the platform, they were going to have to implement, some policies and guidelines to sort of keep up with social sentiment and prevent people from, writing off the platform entirely and getting people to keep using the platform, as we've seen with other like major media platforms like YouTube and Twitch. Though in their case, it's usually to keep advertisers on the platform. In this case, it's to prevent community outrage. But jumping from there, I guess what I want to dive into today as far as Pump goes, and we have a bunch more data now that we have a PumpFun dashboard on the Blockworks data site, is a couple of questions. One, they just launched PumpSwap a few weeks ago. Digging into a little bit of like whether or not that's been successful is maybe a first question. I think everyone is looking around, and there was a ton of like, I'd spoken with the Raydium guys on Twitter a little bit here and there around like whether this is like a winner or not, like whether Pump is gonna be able to take volumes away from Raydium. I think in the case of new pairs, it's kind of evident that was going to happen. We did have a chart from a while back that I'll just throw up real quick, where we were looking at volumes by pool age, and just younger, like less than 30 days pools were seeing a significant bulk of the trading volume. And when you looked at like PumpFun trading volume as a percentage of total Raydium volume, it got up to a massive, like at some cases like 70% of total volumes at the peak. So it's not surprising that PumpFun would go after some of that. But I guess, Jacob, I want to let you talk here some of your like big takeaways and key findings as far as the PumpSwap launch and just generally like trends that we're seeing in PumpFun. What are the things that we should be paying attention to?
Well, I think the first thing is I think the success of PumpSwap is really going to be determined based off of how successful Radium's launchpad is, which I think is called Launch Labs. I mean, PumpFun's main kind of thesis on kind of launching their own AMM is that essentially, the token life cycle, the way it goes is, they take essentially a 1% fee on the bonding curve, and then once that reaches 85 SOL accrued in the bonding curve, that used to go to Raydium. But PumpFun would also take this kind of 6 SOL graduation fee, and that was the end of the token on terms of monetization for PumpFun for these like tokens. And like you've seen all these big tokens that have launched from PumpFun with $1 billion market caps and huge trading volume, and PumpFun's not really getting any of that. So like their main kind of motivation for this has been pretty much to try to capture that fee, which they've launched their pools, which are kind of 25 bips, which corresponds to exactly the same amount of trading fees as the Radium pool. But also like they also took away the graduation fee, which is like a 6 SOL type of fee. And I think over time what you're going to see is like they're going to have to like really pump some volume up to actually make up for that, because that graduation fee, like at its peak in January, February of this year, it was about like $1.5 million of revenue per day. And like that's going to be pretty hard, because the 5 bips that they're getting off of the trading volume itself is very small and insignificant for that. And kind of like what you're looking at right now is that it's really just an extension of their bonding curve platform. Like there isn't really any volume for any of these non-meme coin pairs yet. And I mean, I think it makes sense on the surface. Like there's one pool option, it's 25 bips. There's 20 bips to LPs, 5 to the actual protocol. It's just not going to be competitive with the other existing platforms out there that are charging 1 bip on a Sol USDC pair. And like we've kind of seen that as well. Like there was a bunch of these tokens that kind of had these bridging over events, and there's been very little volume whatsoever on them. Like for example, like the chart you're showing, it's about I think the max was like 300K on a particular day. I think probably the first day or second day. And other than that, it's been pretty insignificant. And like I don't really see how they can be competitive in terms of that. And like there's some like other types of things, like for example, like you know there's this thing in with meme coin volumes that at least for AMMs they have to kind of think about, because they actually incur a bit of price risk in terms of collecting the fees. So I can give like an example, like Radium and Orca, the way that they collect fees is based off of like a periodic of time. So it doesn't happen after every single trade. Essentially, the fees get accrued into the LP. And then after a certain threshold or a certain amount of time that has passed, they'll actually collect them. But you can imagine, obviously, with like volatile assets like meme coins, the time that the trade takes place can also differ by the time that, the price of when they actually collect those fees. So one thing that PumpFun's done is that every single trade, they actually take that, 5 bip on the quote asset of the pool at the time of the trade. And that's really just for kind of like this meme coin trading. Like you wouldn't need this type of logic for, if you're doing a Sol USDC pair, because you're not that concerned about the fact that, a token can go from, 1 to 0 in like a matter of hours, and you won't be able to collect any of the actual revenue. So you kind of see this happen on, like, for example, Radium, like they might have volumes and revenues reporting this, but the actual cash flow that goes to the treasury or to the buybacks can actually differ quite a bit because of that. I think there's probably some trade-off because it's adding additional logic to every single trade that happens on the AMM. And like, the pools are pretty vanilla. And I think with Radium itself, like they're pretty diversified in terms of like they're still getting a decent amount of volume from Sol USDC. So I think they can probably be pretty competitive in terms of the pricing, on terms of the, their launchpad itself. There's been quite a lot of launch pads, in the last probably 6 months. Like there's been Flaunch and Clanker and whatnot on base. And there's even been a launch pad called Pumpkin.fun. Yeah, that's an actual name. But none of them have really generated anything. It's like, they offer all these creator fees, all these cool features, but there's no attention on them. So you kind of have this cold start problem. Whereas Radium, I think like it's a pretty established DEX. I can't think of another DEX that has, the size of Raydium that has launched a launch pad. And I think they can be pretty competitive on the fee. And I know PumpFun, they kind of mentioned in the future they're going to add this creator fee to I think the 25 bips. I don't know if they're taking it out of the LP or of the protocol fee, but I think they're going to probably have to eat that fee in the future because I think Radium's probably going to offer that. And I think they've even mentioned on Twitter that they, brought it up to PumpFun, and PumpFun didn't really want to even use that pool. They'd rather build their own. So I think in the future, like the success is really going to be on how they can actually defend their, dominant position in terms of meme coin trading.
Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduce the world's first secure touchscreens, making it easier and safer to manage your transactions and assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional passwords and enhancing your digital security. Follow the link into today's show notes to get started with Ledger today. I want to prompt a question here. I think that was all great, and you pointed to some thoughts that I think a lot of people have been having. One has been around like, who owns the user? Can these platforms effectively like leverage their brand to continue to like build, have their audience continue to use their platform and then build their trading volumes around that? And I think with Pump, all we've seen so far is that like, if you just move the venue for the trading of these tokens to Pump's own AMM, like, of course, then they'll capture the fees on it. No problem, because they just want to trade the assets. So if they're on Raydium or if they're on Pump, like, I don't think that really matters to them. But it opens up this broader question. And I think we've talked about this metric, and I know you've circulated this chart before, Jacob, but this question of like, do trading bots like own some of the end user relationship with Pump? Does it really matter if Pump owns the liquidity? Because, if some large portion of people doing a ton of this meme coin trading are using trading bots, they don't really care where the venue is, right? They're making a trade through Photon or Bullx or Axiom. It doesn't matter to them if it's sourced from, if it's Launch Lab in the future or if it's PumpFun. They're hitting the buttons in their Telegram bot. And I think you can ask the same question of Raydium. What are you guys' thoughts there? Like, on the one hand, I could see PumpFun using this initial model as like a first step of, we'll just capture the meme coin volumes. But if they can then build out the DEX further and have more offerings with like different fees for different types of pairs, maybe the people who trade memes on the platform will then also trade, their SOL and their USDC and their other assets on the platform as well. But I think this question here kind of brings that, it opens up a broader question of like, are these people really interacting with the PumpFun? Are they like loyal to PumpFun, or do they just, they're just using whatever front end venue, if it's Jupiter, if it's a trading bot, what have you, and they don't really care about PumpFun or Raydium?
Yeah, I think an interesting chart is we have a similar kind of chart for Raydium. So like on the Raydium user, I think tab, there's a trading platform chart, and last time I looked at it, it dropped to 0%. It was originally, I think, 10% of Raydium's volume was going through these trading platforms. And then the day after the pump, swap launched, I think it went down to 0%. So I don't think they're loyal to wherever the actual liquidity is coming from. And I think also a lot of these Telegram bots, trading platforms, they've already integrated Raydium before. So I think they don't have to worry about having to get a deal to have this. Yeah, so you can see it just dropped off a cliff after that particular day. And I think that's already integrated in a lot of these platforms. So once Launch Lab comes out, I don't think it's going to be a huge burden. And I think some of these already have the filter of Raydium pools, because there are some meme coins that still launch on Raydium, even though it's not really a fair launch system or bonding curve system. But I think the infrastructure is there, and it's probably the biggest competitor, I think, to PumpFun's dominance, like I said.
One of the things that I was surprised about is here about the removal of the 6 SOL fee, like for the graduation. My intuition would have been that meme coin creators are not that sensitive to fees, because Jacob, you also alluded to Raydium competing on maybe lowering fees to take market share from PumpFun. But I don't know, like from my perspective, I don't feel like if you remove some basis points out of like the trading experience, you would be incentivized to move over to another application. Like I feel like out of all like like out of all traders, like probably meme coin traders and creators are the least sensitive to like fees. And so in that regard, I feel like PumpFun has a pretty um, huge moat when it comes to like owning the user. And I really don't understand why they will remove like the six sol fee. Like I'm not as deep like in the meme coin like world, but I would feel like they would have the same amount of volume had they kept that.
Yeah, I'm not too sure. Well, I think they alluded to kind of the fact that, well, one, they took the 6 sol away, and then they also reduced the time that it took to graduation. I think there was a waiting period. I forget how long, but now it's instant. I think originally that was a bit controversial as well, and then I think some people have kind of gotten used to it. I think like the interesting thing is like this creator fee. I think, I don't know why they didn't launch it when PumpSwap came online, like the day one. I think like, it just makes sense. Like there's been a lot of people wanting to have a meme coin, but they also don't want to have to sell and, hear the backlash on Twitter and whatnot. And they want to have some type of fee that actually like you don't have to worry about exiting out of your position with. And I'm surprised that that didn't come. And I think, like I've said, Radium, I think probably will launch it on day one. And I think that's the only way you probably can like go after Pump Fun is through that creator and kind of migrate the users. But there is like a problem of like who's starting, like, is it a chicken and egg problem with the people that are actually creating these tokens? Like we have a page dedicated on kind of this. And once you like get into the weeds of that, it's like, there's a few people that launch all these tokens, like 30,000 tokens. They don't really have a huge hit rate, like some 1%. There's been a person that's launched some, 10,000, 11,000 tokens, doesn't have a single graduation, RIP. And like, it's just kind of spammy. Like it's hard to know the incentive for launching these amount of tokens and the amount of cost it would cost to like do that. And it is interesting because like there's no creator fee. So like, yeah.
Yeah, I think this brings up an interesting point, and I was trying to show some of that on the token stats page as well. But I do think that this changes like how behavior is incentivized. So previously, I think it was incredibly common for tokens to basically be like if you graduated, that was very much like it's either dead or it's running to some absurd number. And I think a lot of times it's whoever, if it's someone who's making the token or if it's just someone who's betting on it, like they're very focused on like hitting the graduation. And I guess in that case of if you're the creator, right, you got some kickback when the graduation was successful. Some amount of fee was paid to the token creator in that case, right? If that model changes and now you're like as a creator, you are benefited personally if this thing grows and then does a ton of volume. I do think that changes at least the behavior of how these things are interacted with, and you should see less of this activity where someone creates a token, pumps it up to like whatever that 60, 80K market cap limit is just to get the graduation, and then it just dies because they don't care about it anymore. You could see a larger focus on like if this is a meme coin attached to some trend, like you want this thing to just like grow as big as it possibly can. And maybe that leads to like less explicit, like just constant pump and dumps. And I think we're seeing this a little bit, at least like the graduation rate ticked up significantly, like nearly doubled early here. I don't know if when did PumpSwap officially go live? Was it late March?
I think probably over a week ago now.
So it looks to be tracking that change, that maybe the behavior has shifted a little bit. It's hard to say if that's entirely from this change alone or if just like, some meme coins have been doing well. Like, Fartcoin is doing positively again in recent weeks. So maybe it's just like sentiment has shifted a little bit, but I do think it's interesting maybe to call out a little bit of maybe they're trying to force people's hands in terms of the behavior of how they interact with these. But the other point you give is interesting around the people creating these tokens, like I've scrolled through this as well, and like these top creators, they don't historically have better graduation rates than like the broad, like long running average. Like slightly less than 1% seems to be pretty common. And I think when you look at a lot of these, they're doing worse than that in most cases. And these guys are doing thousands upon thousands of token launches. There's maybe a few cases where they've got a higher rate, but I guess you'd expect that if you're doing thousands of tokens, like you might have some edge or community or other, social connections to like have a better chance of graduating tokens on the or to Raydium historically. But yeah, I don't know. What are your guys' thoughts there in terms of just like, I think this will be a continued focus for a lot of these platforms. So like you mentioned earlier, Jacob, like Flaunchy and some of these other platforms, like their idea was we need to do like fee sharing with creators or fee sharing with the protocol, different mechanisms there. That's what like, I think the Pumpkin one, as well as like GoFundMe, have played around with like protocol revenue share and then having like a token for the base protocol. And then this change from Pump as well. It's like a to target user behavior on the platform. Although they don't have a token yet, there's no like protocol revenue share. Do you guys think that can really be a differentiator here, or are we expecting to just see the winners and the like dominators continue to do well?
I mean, personally, I do think it can be a differentiator, but it's harder if you're not on Solana because that's just where most of the meme coin activity is. Probably why Flaunchy, even with this, innovative thing with the Uniswap V4 hooks, I thought it was pretty clever, pretty innovative, and kind of like wanted to change user behavior, like you said, but maybe not the right chain, and then maybe not the right timing for it. But it's also, symbolic of what made Pump.Fun popular in the first place with the bonding curve to kind of make it more fair for users. And these other protocols wanting to share fees and have a fair launch as well, fair launch Flaunchy. So I think it's in the same vein, right? So I do think it will make a difference. And when Pump.Fun launched, it was originally used by a few people, and then it became more known that this bonding curve was something that helped protect you, and then people had to learn about the bonding curve. And then once enough people knew about it, then other people just took it at face value that it was a fair site, and they built their reputation from that. And I do think like other platforms who implement these kind of mechanisms, these fee sharing and more long-term incentive aligned like protocol designs should capture some market share.
Yeah, I mean, there have been some attempts like by new chains, even for instance, Eclipse is discussing ways to how to redistribute like MEV back to the application instead of like just like being kept by the sequencer or by the validators on like a chain, and trying to add value to the application in that way. But the problem is that you incur some trade-offs by moving away from, like as Mark mentioned, from Solana when it comes to meme coins. And those traders are pretty huge. Like I can imagine, like for instance, in the case of Eclipse, even if you redistribute all of the sequencer fees back to the application, I think an application will be better off like on Solana just earning their normal fees they charge users than, because it's a much larger pie and a more larger like TAM, let's just say, than just being on a chain where there's no activity and like having that advantage, let's just say. But then when you look at the absolute numbers, what you're earning is nothing comparable to what you could earn on a chain like Solana where all the users and liquidity are.
Yeah, I think that's a great point. And I want to share some data here on Soldex volumes and trading bots, but I think that exemplifies a shift that we saw going from like 23 to 2024, where meme coins like really took off on Solana. And prior to then, like Telegram bot trading was mostly happening on Ethereum. You had that like maybe start to take off on some other EVM chains as well, like Binance Smart Chain and even Base. But once memes went crazy on Sol, you saw this big shift, right? Like BonkBot, even Unibot moved to Sol and then renamed to Trojan. And now we have like Photon, Bullx. There's a ton of them that have all been competing over the Solana volumes. Because like you mentioned, the aggregate like nominal amount of trading volume that they're competing for is so significant that the potential revenues are massive. What I think is interesting to see is that, like, specifically for Telegram bots and their share of Solana DEX volumes, they've been pretty consistent over the past year or so, where as a percent of total DEX volume, it's been anywhere from like 5 to 10%. And as a share of like specifically meme coin volume, which is basically what anyone who's using a Telegram trading bot is trading, they've been anywhere from like 10 to 20% of total meme volumes. So I think, like, when you know that the nominal numbers are in the billions, like billions of volume a day, and you're competing for, 10 to 20% of that with a 1% fee slapped on to volume for every trade that they use. Generally, I think most of these bots, they're charging 1%. Maybe they're taking home like 70 or 80 bips net after like incentives and other things, but the revenue opportunity for them has been massive. And so, to your point, like, it's unsurprising to see all of these apps like jump and compete for these highest contention, highest volume spaces. What I think is interesting as well, like more recently, and in the chart that we showed on PumpFun's, like, where users are trading from, with third party apps being like 30 to 40% of activity. Axiom has been like a new entrant here, and they've got meme coin trading on Solana and maybe other chains, maybe not quite yet, but also hyperliquid perps, as well as like you can earn yield on USDC via margin fi. So they've baked in a couple of things. What I think is interesting is that there's a potential that like you could see a shift in activity of, if hyperliquid continues to become this like great venue for trading. I do wonder if the users on these bots and apps, like, if the apps are just going to continue to provide like what the best venue is, like, the users don't necessarily care what the app or the chain that they're on is. They just want to trade where the action is happening. So if all of these front ends and interfaces that people are using are just, oh, now we're tapping into hyperliquid, like, it wouldn't be surprising to me to continue to see like more activity and like this sort of flywheel effect happen there, where it's like, okay, activity is moving here. Okay, more activity moves there because activity has moved there. And then now like the most, liquid and highly traded assets are there as well. Any other thoughts, like maybe more generally on just Pump, Raydium, like this clash of the Titans, and where they're headed?
I'm sort of surprised that Pump didn't kind of go into the trading platform side of things first rather than the AMM. It seems like there's a lot more. I mean, there's just a lot more fees to be captured in that type of side. Like, you're kind of looking at like this power law distribution of kind of traders that, there's going to be a handful of people that probably contribute about, 20, 30% of all fees for these type of platforms that just trade, all day. And like, we have a chart in the dashboard as well that I honestly think is one of the most interesting parts of the PumpFun dashboard. It's looking at kind of like the amount of fees that are being generated for a like a pump fund trade. So a bond increment plus AMM. So you can think about it as like there's a bunch of actors and kind of like this pipeline. We don't include Solana or Jito right now, but in the future we will. So like, for example, Telegram bots, trading platform bots on the financials, like, they are close to capturing almost more of the fees on pump fund trades than PumpFun itself, which is kind of an interesting fact. I mean, it's pretty much a factor that there's like 10, 11 trading bots, and I'm kind of taking the collective of that. But I think like that kind of dynamic kind of shows that like there is quite a lot of fees to be captured on that type of side, especially on the user front end side that we typically overlook in crypto.
For an application that was, the leading one last year, indexes of all apps, leading by revenue, users, you name it. Do we think that they need a token? Like, the team was raking in hundreds of millions of dollars, keeping it for themselves. Essentially, there's no protocol sharing. Like, what's the incentive to launch a token for Fund? I mean, I know what the incentive is, but do we think that the trade-off is worth it?
I don't think it's worth it at this point. I think I think the strategy was correct. I think people give a lot of like a lot of people in the Solana community view Pump Funny in negative light, especially like in recent months, saying that it's a net negative for the ecosystem. I don't think that's true. Like, if you look at Pump Fun, they brought in millions of dollars in like revenue, and they were selling that soul. But at the end of the day, it's a business, right? Like that's what they're supposed to do. And in crypto, we usually take these like maybe socialist stands sometimes, where we think like applications shouldn't make money and look at them as extractive, when in reality, like that's the whole point. Like the whole point is to have like successful businesses on chain, and you cannot just like pay the bills with soul. So I think Pump Fund's strategy was correct, not launching a token, and like it was like the rational choice, like just to keep it for themselves. And I mean, what's the incentive to launch a token? It would just be extractive. People would have been mad after it went down, and then it would just add unnecessary controversy for the team, in my opinion.
I think I generally agree with Carlos here. I do see the point. Like me personally, I would have loved to have bid a pump fund token. So like I can understand the like obsession or argument of like, man, they should have done a token because I wanted to buy it. But I think the reality is that like they didn't necessarily need to, right? The idea clearly took off. They made a ton of money. They like didn't need to raise funds for anything. I mean, they went through alliance, so they had they had some funding to kind of start things out, and they surely raised some capital from some investors, um, and the idea took off pretty quickly. So yeah, the only other reason would just be to like, I could see the value in maybe launching a token and then trying to like continue to steal market share or vampire attack another platform if they struggle to do that without launching a token. If the goal is to like take down all of the Solana dexes and like take over the ecosystem, like, maybe you could use that as a incentivization mechanism and like really like start to steal market share from other players. But I don't know that they necessarily need to, because they've been just so successful. Like it's hard to say that they should launch a token when they've made like Carlos said, they made hundreds of millions. They have plenty of funding. Like they could build out whatever they want to expand this product further. All right, we're getting near the end here. I think we talked plenty about Pump Fun. I think that was great, diving into the dynamics. I guess what I want to ask more generally now, like looking forward, and I've asked this question a lot of different ways. And recently we've talked a lot about like stable coins, tokenization, different things along those lines with DAS and the institutional focus behind us. I think I want to ask outside of that realm, like where do we think like the next interesting, like great opportunities can arise from in crypto? Ignore stable coins, ignore these tokenization things that we've been talking about for weeks now. Carlos, I know you just recently wrote about SVM chains. Mark, you just wrote about a DEX on SWI and like, its relationship within the SWI ecosystem. I think these tend to be common ideas, right? Like new chains come out, people get excited about them generally. It's been like historically a very good trade, right? Like if you look at, 23, 24, 25, then like Solana, SWI, Hype, like those were things that did well. You could argue that Hype is just an application, but now they're building the Hyper EVM. So I think we've seen like this consistency here in, new chains that gain dominance have been very good to buy. So I guess where are we looking and what are we thinking about going forward? I know you mentioned earlier apps could be the winners, but there's no Pump Fund token. So what apps?
Um, I think I'm seeing like two main like opportunities, if you will. Like the first trend I'm seeing is apps sort of converging upon the same design and diving into these like multi-product DeFi that we've been talking about lately. So, for instance, Camino launched their swap product that leverages Bith's Express Relay, and it's essentially using just an off-chain auction with market makers to find the best price execution for traders, and often even returning a tip to the user. um, Drift also launched like their Swift protocol, or announced it, which is also using like an off-chain auction. Like Jupiter, also something similar with RFQ. You have DFlow on Solana, like also with conditional liquidity, trying to solve for toxic order flow. So I think like a big trend is just trying to solve for this big issue, which is toxic order flow specifically. And I think like on an L1 with permissionless validators like Solana, you cannot do that very easily. So you need to rely on some off-chain components. And I think that's why we've been seeing also new chains like with novel designs that are also trying to solve for the same issue, but with a different approach. So, for instance, Atlas is a new chain, like a new SVML2 that's being developed by the Ellipsis Labs team, who is behind the Phoenix Club on Solana. And they specifically chose to build an L2 because you have a centralized sequencer, and that sequencer can have like an opinionated ordering of transactions, which you cannot just have like on a chain with like permissionless validators. And if you do have like uh, opinionated ordering of transactions on an L1, you typically have to restrict the validator set quite extensively. And Hyperliquid is one example of this, where you have a very small validator set that can allow you to have like good price execution. Fogo is a new chain that's also having like a permission validator set, and again, the same reason is there's no other really way to reduce toxic order flow. So yeah, that's one of the trends that I'm seeing, like just teams trying to figure out ways to reduce like MEV and improve on-chain liquidity. And then the other thing I think there are some good like farming opportunities. Like if you look at Solana, there are protocols like Radex or Exponent Finance. I think Luke talked about Radex previously, which is like sort of like Pendle but on Solana. I think that's an interesting protocol. You have like new novel designs that are under discussed, in my opinion, such as Loop Scale, which is like if you look at the credit or the lending landscape, like most protocols, like basically since Compound popularized the pool-based design in 2018, like we haven't moved past that pool-based design for money markets. And like Loopscale and other protocols are trying to be novel approaches like credit order books. And I think that's really interesting. And right now that like prices are down, like the trading activity is maybe not as exciting as it was a few months back. Maybe it's interesting to just experiment with this like sort of more boring applications, uh, and maybe they can in the future have some interesting like airdrops. You can just do interesting strategies with stable coins or like with Sol or whatever.
Yeah, I'm gonna piggyback on Carlos's first one in a combination. His point of a lot of these apps vertically integrating and adding off-chain solutions, and then also these SVM chains coming up, these L2s like Eclipse or Atlas, these L1s like Fogo X1. Like if you like look at if you look at us both of those trends and kind of look back to like 2020 when a lot of EVM chains are popping up, like Avalanche, C Chain, Binance. Like look at the applications that are going to do the same thing that applications did back then, but just for SVM. So Metaplex, for instance, they're on Solana. They have the NFT standard. They're Monopoly. They're on Eclipse. They're on X1. What's going to stop them from what's the hindrance from stopping them from going on Atlas or Fogo or these other chains too? And why would they not use them as well? And things like that's that vertical integration, and also they have Aura coming out with their I call that their own like DA layer as well for Solana. I also see Jupiter as the same way. Like, why would Jupiter not also launch on these other chains, especially with their plans to have JupNet to be an aggregator of multiple chains? And obviously SVM chains are going to be the lowest hanging fruit for them because that's what the base is built out on. So I think look for the apps that have already vertically integrating. Maybe they're on Eclipse already. Maybe they're on another. Maybe they have plans for another chain, and run that same playbook that we saw some of these other apps do with Ethereum and all these other EVM chains launch and proliferate. And now, not only are they're diversifying within their own integrated stack, but they're diversifying with different chains as well. So I think that's one to look out for.
I I think I somewhat will disagree with that take in the
Okay.
sense that I think like the storyline with the EVM will play out very different to the SBM storyline in the sense that Solana developers are laser focused on keeping users and liquidity on the L1. So if you look at the applications that have launched on Eclipse, you have like you're right, you have Metaplex, you have Orca, you have Lifinity. But if you look at the leaders of Solana DeFi today, like in each of their respective verticals, like Jupiter, Camino, Raydium, etc., none of these applications have launched on new SBM L2s. And I think that reflects on their laser focus efforts on keeping like users and liquidity on the L1. And that's sort of what I was alluding to earlier. For instance, Camino doesn't want to launch on like Atlas to solve for toxic order flow. They want to launch their own solution on Solana so that users stay there and they can maintain that liquidity. I think there's like this probably negative self-selection bias where applications on Solana that haven't done very well or have maybe lost some market share are expanding to other SBM chains because they are losing on like the Solana L1, if that makes sense, and they're trying to make up for it in another way. So I think that in that way it will play out different than the EVM plot, where you have like Aave and Uniswap launching on every single EVM that launches and dominated that market. Whereas in Solana, I don't see that like ambition from the leading teams to launch a new SBM chains. I'm seeing more like a focus on keeping the users and the liquidity on the L1. But that being said, I think that competition is great, and that Atlas, Fogo, or whatever can be net beneficial in the sense that you have like real competition and efforts to like solve toxic order flow in another way. One thing I'll say is that I spoke to the Fogo team, and then some of them said that they aren't really targeting like Solana applications. Like they're going after like a new market essentially. So I don't think we'll see many Solana apps launching on Fogo, to be honest, when it launches.
That's actually a really good point. So
Mhm.
maybe more so the apps that either don't care about liquidity as much, like Metaplex, which just NFT standards and minting, and then maybe ones that try to solve the liquidity fragmentation among SVMs, like the Jupiter with JupNet. So yeah, solid point, Carlos.
Yeah, I think you make good points, Carlos, and I'll maybe add some context there as well. Like, I think the EVM example, like we saw a lot of vanilla copy pasting of like, these 10 L2s didn't really make any, modifications to the EVM. They just like launched. It's like same throughput, same initial design, and so it's like, sure, let's just copy all these same apps over there. I don't. It doesn't really appear that that's the case here on the SVM side of things, where they're just like straight up copy pasting Solana, like you mentioned, Carlos. They're trying to specifically solve for specific problems. In some cases, if it's toxic order flow, maybe they have permission validator sets. Maybe they're making other tweaks to the design, which might make focusing on those two like slightly different ecosystems a little bit harder. And then the other point I want to make is like, I think historically we do see that native applications to an ecosystem tend to sort of outrank like the copy pasters around the world. Like even if you look at Base, right, like Aerodrome kind of grew up to the top really quickly and outclassed Uniswap, even though Uniswap is like, the classic, like, let's just drop Uniswap on this new EVM chain. I think you just tend to see that like that laser focused team that's specifically interested in that one ecosystem is able to, more effectively rally a community. And obviously then like if they have a token that's not competing with like the activity or the revenues or things happening on other chains, then it's like more relevant to the people that might want to buy or trade or stake or lock it or what have you. Um, so I think those are maybe some points in favor of Carlos's idea, which I think makes sense. I mean, I think there's points to both sides, but I do think what he's saying makes sense pretty strongly in this case. Jacob, I'm curious about your thoughts. We don't get to hear from the data guys outside of Dan Smith, who's very loud on the timeline and in the chats. What are you excited for? What apps, what chains, where are you looking?
Right now, probably honestly Fluid, just to name one single app. I'm pretty interested in more the institutional kind of side of the trading and lending, and that's kind of what Fluid is mainly built for. We just published a dashboard last week on that, so some of the data is pretty fresh in my mind, and it's like something like I think most of the data is coming from MEV bots, coming from market makers. I think right now, especially if we go kind of through this little slump period, if you want to call it that, in crypto with kind of like depressed volumes for a bit, I think kind of this institutional side, I think is still a pretty good bull case, especially for legislation the next couple years, hopefully, or whatnot. And I think like I think Fluid, especially them kind of branching out to more of these chains now, which I know obviously Carlos just mentioned, probably not the best thing, but at least in the EVM landscape, it's one of the ways you kind of have to survive. And I think them branching out to now Base, which I think they're going to be launching a DEX pretty soon on that side, because as of right now, it's just Ethereum and Arbitrum. But on the lending side, I think kind of institutional side, I'm pretty interested in that. And then also, like you said, there isn't really much tokens on the kind of like this user interfacing, kind of this like, trading platforms. There's not really a lot of tokens on that, but I think Axiom in the future will probably be launching a token or some sort of that with a currently running a point system. And I think something like that, where the users are completely controlled in terms of that, is going to be pretty interesting on the retail side of things.
Awesome. I'm going to +1 Axiom. I think it's interesting. I think they're doing a lot of things right that I think trading bot teams maybe should have been trying to focus on over the past year. But we'll see how that one plays out. They've been having a strong start so far. All right, I think it's about time to close it out. You did mention depressed volumes. I think we've got a bunch of depressed personalities on the timeline. Everyone is, I would say, probably crying in the casino lately. Any any big takeaways outside of the apps? I think my big one would just be maybe log off and touch some grass if you are ripping your hair out right now.
It's a big day for liquidators, essentially. That's like the main winners in the last week. So I know there was a big closeout on like an Aave position, but that's pretty much the only people that are really happy.
That's fair. You guys heard it here from Jacob, the data wizard himself. Just simply don't get liquidated and you'll probably be fine. Hopefully we will see some of you guys at Permissionless this summer. Reminder to get your tickets. It's 0x10. And thanks for tuning in. And thank you guys for coming on today. It was great.